Welcome back to Investing Talk Podcast.
Today we're looking at FEMY.
As usual, before we start, subscribe, like, and comment to this video to support the show. And if there's a specific company you want us to look into, leave it in the comments below.
So let's get into the analysis. This company presents, well, one of the most exciting yet kind of terrifying dilemmas we've seen in a while.
How so?
You've got these two narratives just fighting for control. On one side, there's this clear, accelerating growth story. It's all powered by some really innovative medical tech.
Okay, that's the good part.
Right. But then on the other side, you have these immediate, almost existential financial questions that could, threaten the whole operation.
It's a classic case then. Innovation running headlong into cash flow reality. So the bull case, I'm guessing, is all about their flagship product.
Entirely. It's all dependent on their ELA system. That's an IUD, an intrauterine device delivery mechanism. And if you look at the recent financials, the momentum is undeniably strong.
Right, so let's start there. The numbers.
Okay, so Q4 2024 results. They reported $2.1 million in revenue.
Which is a 28% increase year over year. That's not bad at all.
It's good, yeah, but the real story is where that money is coming from. It's the international markets.
That's the engine right now.
That's the engine. I mean, in Q4, Europe and Latin America drove 70% of that quarterly revenue. That's $1.47 million.
So what does that tell you?
It tells you ELA isn't just some niche product. It's actually achieving commercial scale. It's gaining traction in, reimbursement systems all over the world.
And that shift away from just relying on the U.S., it kind of de-risks the domestic regulatory process a little bit too.
Exactly. But beyond just the sales figures, the most compelling part of the bullish argument for me is the rapid expansion of their efficiency.
You're talking about the gross margin.
I am. It soared to 58.4% in Q4 2024.
Wow. And that's up from what, like 48% year before?
48.1%, yeah. A 10-point jump in gross margin is massive for a hardware-focused medical device company.
It's about the clearest signal you can get that their scaling isn't just about volume, but they're getting more profitable per kit.
That's it. That efficiency gain is tied directly to manufacturing improvements and a better product mix. They're just selling more of the higher margin ELA kits.
And this allowed them to slow their cash burn.
Right. They still posted a loss, but the net loss narrowed, and pretty substantially. It went from $6.1 million down to $4.3 million year over year in that quarter.
And if you look at the operational side, the adjusted EBITDA loss improved to negative $2.1 million.
And that's key. The fact that the adjusted loss is getting smaller tells you the core business, making and selling ELA is inching closer to profitability, even while they're spending big on clinical trials.
So management's confident this can continue.
Oh, clearly. They put out really strong 2025 revenue guidance. They're projecting between $10 and $12 million.
That's some eye-watering growth. 45 to 72% year over year.
It is. But let's be super clear here that guidance is hanging on the successful and timely U.S. clearance of their new product, ELA+.
Okay, which brings us to the competitive moat. I mean, why should anyone care about this IUD delivery system? There are others out there.
It really boils down to innovation that's protected by a wall of IP. We're talking 17 U.S. and 21 international patents.
But what's the actual clinical advantage?
So to really get the moat, you have to put yourself in a physician's or a patient's shoes. Traditional IUD placement, it's often uncomfortable, it can be time-consuming, requires a speculum.
Dilation sometimes, right?
Exactly. ELA just changes the whole game. It's a proprietary, single-use, hands-free technology.
So no speculum, no dilation.
And no manual alignment by the doctor.
Yeah.
You're taking a procedure that could take, 5-8 minutes, and cutting the actual placement time to under 2 minutes.
For a busy clinic, that efficiency is everything. That's the real edge.
And they're not stopping there. They're extending that advantage with ELA+, which is in trials right now.
This is the one with AI.
Yeah, this version integrates AI-assisted placement guidance. It's shifting the device from just being a tool to a sophisticated decision support system.
Which raises the barrier for any competitors trying to catch up.
Immensely. And the regulatory world seems to agree. Back in March 2025, they expanded their European CE mark to cover 37 nations.
That's a huge market boost.
It is. But the big one, the big catalyst, is here in the U.S. In February 2025, the FDA granted fast-track designation for ELA+.
And that's for a specific group, right? Nulliparous women.
Exactly. Women who haven't given birth, IUD placement can be tougher for them. So getting fast track suggests the FDA sees a real unmet medical need here, and it dramatically shortens that regulatory timeline.
Which supports that aggressive revenue guidance we talked about.
It does, and you can see the institutional money is following that momentum. Institutional ownership jumped to 42%. That's up from just 26% a couple quarters ago.
Big funds don't move that fast without a strong belief in the product.
Nope. We saw Viking Global Investors added 1.1 million shares. And it's not just the big guys either. The insiders, the CEO and CFO, they bought over $500,000 worth of shares in early 2025.
Skin in the game.
Yeah.
That's always a powerful signal.
It is. So, I mean, that's a fantastic bull case, right? Strong product, exploding international growth, expanding margins, and a fast track in the U.S.
Absolutely. Now let's take that entire narrative and throw it directly into the garbage disposal, because we have to pivot hard to the bear case.
And this is where the story gets, as you said, fascinatingly terrifying.
The uncertainty here comes from a massive conflict in the financial reporting about their cash.
It really changes the outlook. I mean, it goes from a high-growth medtech story to an immediate survival story.
Okay, survival story might be a little strong, but let's look at the numbers. The bullish view from their big annual report suggests they ended 2024 with a pretty comfortable $27.3 million in cash.
And no long-term debt. Based on the burn rate we just talked about, that's like a 2-year runway.
Sounds perfectly safe. But then you have these other reports citing disclosures from just a few months later, in early April 2025.
And they paint a totally different picture.
A fundamentally different situation. They show cash reserves of only $3.1 million as of the same date, December 31st, 2024.
And that's alongside a pretty staggering $12.8 million full-year net loss.
Right. And this discrepancy, this is the core dilemma for you as an investor. If that $3.1 million figure is the real one, then that 2-year runway is just gone.
Completely obliterated. The difference between $27 million and $3 million isn't a rounding error. It demands an explanation.
It makes you wonder, right? Is it an accounting thing? Did they burn through cash way faster in Q1 than anyone thought? We just don't know, and that ambiguity is poison for investor confidence.
And their financial health is made worse by this reliance on a second product that just isn't delivering.
You're talking about FEMY.
Exactly. The company is focused on commercializing FEMY, which is this office-based visualization system.
Focused on it, sure, but the numbers show no meaningful revenue from it at all.
Right. So they're sinking money marketing, staff, manufacturing into a product that is basically dead weight right now. The expectation is that operating losses for Q1 2025 will stay high, maybe $3 to $4 million.
If that $3.1 million cash number is real, that Q1 burn alone could wipe out everything.
It could, and that highlights their absolute reliance on the capital markets just for oxygen.
And we saw evidence of that in February 2025. They filed a Form S-1 for potential at-the-market, or ATM, equity offerings.
An ATM isn't a single big sale of stock. It lets the company just continuously sell small amounts of new shares right into the market over time.
Like a constant fire hose of dilution. It signals they're planning on raising cash on demand just to keep the lights on, which just puts pressure on existing shareholders.
And then in April, management came right out and said they were pursuing strategic alternatives to get more funding. That's classic code for we need cash and we need it now.
Okay, so outside of that existential cash problem, what are the key operational risks?
2 main ones, timing and concentration. Risk 1 is a U.S. regulatory delay for ELA+.
Even with the fast-track status.
Even with fast track. The FDA could ask for more trials or just drag its feet on the final clearance. If that happens, that aggressive $10 to $12 million guidance for 2025 is immediately toast.
But the clinical data was strong, wasn't it?
Very strong. The p-value was 0.008 for improved placement. That's compelling evidence that should help streamline things, but, it's never a guarantee with the FDA.
Okay, so that's risk 1. What's number 2?
Concentration. We celebrated that 70% international revenue, but 70% of that revenue came from just 5 countries.
That's a lot of eggs in very few baskets. It exposes them to some pretty big localized risks.
Specifically, currency volatility. Their reliance on the euro and a few other currencies means a strong U.S. dollar can really hurt the value of the money they bring back home.
It eats right into that beautiful margin we were just celebrating.
Exactly. Now, to their credit, they know this. They started a currency hedging program in January 2025. But the concentration risk, relying on the stability of just 5 major markets, that remains.
So this brings us to the synthesis, the big question. You have to decide. Is FEMY a growth company with a proven, patent-protected product that's taking over the world?
Or is it a struggling development company facing an immediate cash crunch because one of its products is a dud and it constantly has to dilute shareholders to survive?
It really feels like a binary bet. It's all about the timing of that Ella Plus approval versus the speed of their cash burn.
We need clarity, and luckily, the next few months are completely packed with events that should give us that clarity.
Okay, what's on the calendar?
First, and this is the most crucial one, the Q1 2025 earnings release. That's expected in late May.
That's the one that will settle the $27 million versus $3 million cash debate.
That's the one. Right after that, on May 28th, is their Investor Day. You'll want to watch that for updates on their pipeline, partnerships, and that regulatory path for Ella Plus.
And then June is big for regulatory news.
Huge. We're expecting the FDA decision on Ella's expanded indications sometime in June. Approval seems highly probable given the fast-track status, and it would be a major catalyst.
And finally, also in early June, they're supposed to present peer-reviewed data on Ella Plus at the big ACOG annual meeting.
Yeah, that's where they show off the AI-assisted placement data to doctors. If those numbers are compelling, it sets the stage perfectly for a U.S. launch.
So the future of FEMY really just hinges on which set of financials is real and whether that revenue momentum from Ella can outrun the constant need for cash.
The next 60 days will likely determine if this is a breakout success or, well, a desperate dilution tale.
It's a true high-stakes, event-driven period. If you want to keep up with how these catalysts play out, make sure you subscribe so you don't miss our updates.